The government's economic growth target for this year has been set at 3.1%. Relevant officials have vowed to dedicate the new year to normalizing the local economy. For more, I have Professor Yang Jun-seok from the Catholic University of Korea. It's a pleasure to see you again, Professor Yang.
Happy to be here.
I also have Professor Kim Se-won from Ewha Women's University. It's good to see you again, Professor Kim.
Thank you for having me.
Right, Professor Yang, what are your prospects with regard to the Korean economy this year?
Okay, well, the government has targeted 3.1%. I think that is possible, but it will be difficult. And the reason is that Korea's potential GDP growth rate, the growth rate that you would have under normal conditions without anything unusual, is thought to be between 2.0 to 2.5% right now. So we need an extra push. Now, in 2021, that extra push came from mostly exports. We had the best exports year that we ever had, and perhaps even some facility investment, which was which grew by 8.0%. This year, in order to achieve that 3.1%, in order to have that extra push beyond the potential growth rate, the government hopes that we will continue to have very high export growth or export level. They project the export to grow by 2.0% over this year. Now that would mean that because we had the highest export amount ever last year, it would have to repeat that highest level ever this year, and also there would have to be a spike in consumption. Government projects that the consumption will be 3.8% growth this year, but the last time that Korea had consumption growth over 3.8% was in 2010. So that assumes that we will have so-called revenge spending, some pent-up demand that will get satisfied this year, the pent-up demand which was repressed because of the COVID-19 pandemic, that will take place this year. But both, it's possible, but it will be difficult. And the reason is for consumption, we still have the pandemic going on. We still have distancing measures in place. So we don't know if the pent-up demand will be realized. And then the K-shaped recovery that we had, a lot of people are doing well, but a lot of people are not doing well. So we don't know whether that extra push in consumption will take place. In terms of exports, last year, one of the reasons why we had such a high exports to begin with was not only that the volume of exports increased, but the value, the price of exports increased as well. So in order to achieve high export growth this year, we would need not only an increase in volume, but also increase in prices. That would mean that in some sense, we hope that the global inflation will continue. But there's a counter side to that, which is that if the global inflation continues, we will have higher values of imports as well. And just mathematically, this doesn't necessarily mean that it's bad for the economy, but mathematically, if you have higher imports, then you have lower GDP growth. So 3.1% is possible, but Korea will have to be somewhat lucky to achieve that.
Right. And against this then rather ambitious goal, Professor Kim, Korea's top financial regulator has warned about the presence of a grey rhino headed toward the local economy and thus the need for countermeasures. Do tell us a bit about this metaphoric expression and about the risks that you believe the economy faces.
Even though Korean economy recovers fast this year, there are lots of uncertainties and risks forthcoming inside and outside of the Korean economy. The Great Rhino is, as you said, metaphor for serious risks that we can see and acknowledge, but we do nothing about it because people know very well about these risks. The Great Rhino that Mr. Ko, the head of Financial Supervisory Service, talked about is the risk forthcoming in the financial market, but almost every participant of the financial market acknowledges the risk. According to financial markets participants, the well-known risk is asset market bubble in both in equity market and real estate market. As we know, Bank of Korea raised the key interest rate up to 1.25%, and it is highly expected that they will raise the rate further 2 to 3 times more this year. And since the boom of the market, financial market and real estate market has been driven by this low interest rate and ample liquidity. The higher interest rate has the power to adjust the markets. So if that adjustment process does not go smooth, it can trigger another round of economic recession by decreasing domestic consumption and investment.
Right, I see. Professor Yang, as Professor Kim mentioned, as part of efforts to reinstate that is perhaps a normal policy setting, the Bank of Korea raised further its interest rate to 1.25%. Was this level of increase within expectations?
Oh, it was well within expectations. Since about the summer last year, the Bank of Korea has given strong signals that it wants to raise the Korean policy interest rate 3 times by 0.75 percentage points in total. And this recent rise last week was the third rise. And so in total, it did rise by 0.75 percentage points. And then the Bank of Korea has said that they will wait and see what's going on in the economy before they decide perhaps to raise the interest rate further. And the interest rate rise was expected in January because we have a presidential election in March. And the central banks, not only Bank of Korea, but central banks all around the world, really are reluctant to raise the rates just before the presidential election. So it was widely expected that the Bank of Korea would raise the rates for the third time in January, and that's exactly what happened. They expect a 0.25 percentage points increase. Again, that is exactly what happened. What remains in question is how many times Korea will raise the rates this year. That is still a bit up to question. A lot of the market analysts are expecting the Bank of Korea to raise the rates twice more this year. I personally think they will raise it more. But the big question is how many times will Bank of Korea raise the rates this year in addition to the January increase?
Right. Now, Professor Kim, as Professor Yang has mentioned, the policy rate has been raised 0.75 percentage points within a span of 5 months. What are your thoughts on the pace of this increase?
Bank of Korea says that it is necessary to raise the key interest rate because of 2 reasons. The first is financial imbalance, and second is very high inflation in Korea. Here, the financial imbalance is about the fast rising household debt, which exceeds 1,800 trillion won. So according to simple calculation, the size of the household debt is about the size of the Korean GDP. So the ratio between the 2 numbers, household debt and GDP, is simply the highest between OECD member countries. Also, last year's annual inflation was 2.5%, which is the highest in a decade. And this high inflation is pretty much affected by foreign factors and supply factors like global production chain disruptions and high prices in agricultural products, which came from the world's poor harvest in main countries. So this kind of high inflation will be continued for a while. And the first job of the Bank of Korea is a fighter against the inflation. So I think they legally and by responsibility, they will be sticking to the job of fighter against the inflation for a while.
Right. And keeping in mind what Professor Kim has just said, Professor Yang, do you believe the rise in policy rate will serve to stem inflation?
I think it will have a limited effect, but we need it anyway. And the reason is that unlike the United States, where they had a very strong increase in demand, Korean increase in demand was not as strong. And a lot of the factors behind inflation is supply-based. We've been hearing about bottlenecks in production, not only in Korea, but overseas. Bottlenecks in transportation, especially marine transportation. Monetary policy, the changes in interest rate can do very little on those fronts. So increasing the interest rate, at least for Korea, will not affect those international factors or supply factors. But what is concerning is that if the current inflation raises people's expectations of future inflation, that may make inflation higher and longer. So the central banks, not only in Bank of Korea, but the United States as well, part of the reason why they're raising the interest rate is to try to dampen down people's future expectations of inflation. And I think for that reason, Korea does need to increase the interest rate. But the primary reason is what the professor just mentioned, which is increase in household debt. And I may also point out corporate debt as well. Corporate debt is, at least in terms of amount, higher than the household debt for Korea. And it's among the 5 top GDP to corporate debt ratio in the OECD, so that has to be dealt as well. So to deal with debt problem, you also need to raise the interest rates. So there is plenty of justification for the Bank of Korea to raise the rates.
Right, and staying with that, Professor Kim, what can you tell us about the impact of this latest hike in the policy rate on the household debt and stock market, as well as the real estate market?
There have been many factors that boost up domestic real estate market and equity market, but there's no question that low interest rate along with ample liquidity has been the main driving force to raise up these markets. It means that as Bank of Korea raises interest rate, these markets, both of the real estate market and equity market, will be a little bit shrinking down. We never know when exactly and how much these markets goes down along with higher interest rate. But what we know is higher interest rate has enough power to adjust these markets downside. Actually, as Professor Yang pointed out, both the Bank of Korea and U.S. Federal Reserve know that this higher interest rate makes asset markets shrink a little bit, and that can cause a very serious problem of lower consumption and lower investment, which is related to another round of recession. So Bank of Korea will be kind of extremely cautious to avoid this kind of sudden drop of the markets. Actually, in global financial market, it is well known that technology stocks like Google, Tesla, KakaoTalk, Naver are much more sensitive on higher interest rate. So these stocks are already declining a little bit. Instead, pro-cyclical stocks that is related to recovering economy is a little bit rising up.
Right, I see. And moving beyond national borders, Professor Yang, there is talk that the U.S. Federal Reserve will push up its key interest rate by a total of 4 times this year. Do you share this outlook?
I've shared that outlook. I think the Fed is signaling, well, they were signaling last time, if you look at the Fed's so-called dot chart, they were planning to raise it 3 times, and this was in December report, but I think inflation has become even more critical for the United States, so there's a good possibility, and market is expecting the Fed to raise the rates 4 times. I personally expect the first rate increase to take place in March. And for Korea as well, I think Korea will try to follow the U.S. When U.S. raises the rates, Korea will raise the rates also. They may skip March because Korea has raised the rates 3 times already. But after March, when U.S. raises its rates, I think Korea will raise the rates also, unless the Korean economy is in too much of a problem. The reason I expect that is because Korea does need to raise the rates fairly quickly. And secondly, there's a possible problem if Korea's rise in interest rates are slower than the United States, because that may increase the possibility of capital outflow, and it may cause some problems in the foreign exchange currency market as well as the foreign exchange rates. So I think Korea will try to match the U.S. increase by increase.
Right. And staying with that, Professor Kim, do you share Professor Yang's outlook with regard to further hikes by the BOK?
Well, I think according to many surveys, the general expectation of financial market is Bank of Korea would raise the interest rate twice, up to 1.75% by the end of this year from current 1.25%. As inflation exceeds 3.7% in December last year, it is true that Bank of Korea top policy priority is given to stabilizing inflation rather than economic recovery. But if economic recovery does not go well this year, there is a possibility that Bank of Korea would reconsider policy priority structure between stabilizing inflation and economic recovery. For example, if economic growth is weakened below 4% economic growth rate of this year, which is the target of the government, then I think the possibility is very high for Bank of Korea to reconsider the policy priority between raising interest rate for stabilizing inflation or boost up the economic recovery.
Right, so there are variables in place.
Right.
Professor Yang, there have been fluctuations within the foreign exchange market amid persisting economic uncertainties, compounded, of course, by Omicron. Having said that, what is your outlook with regard to the forex market and its potential impact on the local economy?
Okay, well, the dollar has been gaining strength because of the Fed's announcement that they will raise the interest rate. I think that also has partially to do with limited flight to safety. What I mean by that is last time that the Fed reduced purchasing of bonds, we had what's called the taper tantrum. We are not having the taper tantrum this year, but I think the market is nervous enough so that as the tapering continues and U.S. first starts to raise the interest rates, they want to go into safe assets, and internationally safe assets are dollar assets. So I think at least until the next couple of months, we will see a strong dollar, weak won. But after that, I think things will return to somewhat of a normality, especially if the Bank of Korea matches the U.S. Fed in raising the interest rates. So I expect the interest rates to return to about where it was last year, $11.50 per dollar. But for at least next couple of months, we may see a weaker won, stronger dollar. Having said that, stronger dollar usually helps Korean exporters, but because Korean exports are already very strong, I don't think it'll help the exporters all that much. On the other hand, the strong the strong dollar will make the imports more expensive, especially oil. So it will raise the value of imports, at least for the first few months of the year. And that's one of the other reasons why I think the GDP growth rate of 3.1% will be difficult, because as I mentioned before, this is not necessarily bad for the economy, but growth in imports do drag down the GDP growth rates.
Right. Professor Yang, President Moon Jae-in is currently on a trip to the Arab countries. What are your thoughts on the potential, perhaps, economic gains to be garnered via this latest venture?
Okay, well, the press has been picking up the keywords hydrogen, exports, and construction order. As we saw in the beginning of the broadcast, President Moon is really emphasizing the hydrogen economy aspect. The Middle East is trying to phase out of the fossil fuel markets and move into other assets of energy, clean energy for the most part. So President Moon is trying to hit the hydrogen power aspect of it and also atomic power aspect of it. The Korean company Woojin just signed a contract with a company in UAE to provide services for nuclear power plants. And also we just seen the President Moon trying to export some construction of so-called smart cities, which Korean construction companies were interested in. I think those are the things that President Moon is trying to push. Whether he will make that big a difference, I don't think so, because usually these things are negotiated between the behind the scenes rather than upfront by politicians and diplomats. But still, it'll make a good showcase.
Right, so it is a step in that direction, though. All right, Professor Yang, as always, thank you very much for your thoughts. Professor Kim, thank you very much for your time and your insights today.
Thank you very much.